Welcome to Market Catalysts, everyone. I'm Brad Smith, and we are 30 minutes into the U.S. trading day. Let's get to three market catalysts that we are watching this hour. First up, we break down the latest read on the economy as breaking economic data crosses the wire. Plus, the tax bill debate continues in Washington. We'll bring you the latest headlines with Treasury Secretary Bessent saying he expects the bill to be passed today. And we break down trades and the risks as the deadline to make deals looms in Washington. All that and much more coming up on Catalyst. Let's get a check of the markets here to begin today's hour and Market Catalyst show. Taking a look at the major averages. Don't look now, but we've turned positive on the Dow. As of right now, we're seeing fractional gains here intraday. We're up by about 0.2% at this point. S&P 500, of course, coming off of 2 days of record highs here. Well, right now, we're seeing a little blippity of a pullback. We're down by about 0.1%. We'll monitor that closely here. And then additionally, taking a look at the NASDAQ, as that is lower by about 0.3%, 30 minutes into today's trading session. All right. You came for the breaking economic data, so let's kick off this morning with some fresh economic data. We just got the latest job openings and labor turnover survey for May. Senior reporter Allie Canal has the breakdown. Hey, Allie.
Hi, Brad. Well, it's looking good here, particularly when we look at job openings. They came in well above expectations. The estimate was for 7.3 million job openings, and we got close to 7.8 million, and we far outpaced what we saw the previous month as well. So that edges the openings rate to 4.6%. We also saw the quits, the number of quits that we're seeing in this market edge higher as well. So this suggests more confidence in the labor market here, especially as we head to that crucial jobs report on Thursday. And then on the manufacturing front as well, we also saw some improvements there. ISM manufacturing registered a reading of 49. Now, any reading below 50 signals contraction in the sector. So we are still contracting. However, that level of contraction has slowed here. We saw the prices paid index edge up slightly, 69.7 compared to the expectations of 69.5. And that comes as tariffs has raised a lot of those input costs for those manufacturers. New orders also decreased from the month prior, along with falling short of expectations, 46.4 compared to expectations of 48.1 here. But we also received a second check on the manufacturing sector from S&P Global, and that came in strong, 52.2. The survey expectations was 52. A lot of positive commentary there on a rebound in the sector overall. So certainly a thing for markets to hang their hat on with this data coming in stronger than expected there. And again, sets us up for that crucial jobs report later this week, Brad.
All right, Allie, thank you so much. Big week of jobs data indeed. Well, as of this morning, investors still pricing in the first rate cut of 2025 to come in September. Fed Chair Jerome Powell, speaking earlier today at the European Central Bank Forum, said the Fed will remain paused until seeing the ultimate impact of President Trump's tariffs.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
So with the July 9th tariff deadline bearing down, just 8 days away at this point, pressure from President Trump and a week of economic data ahead, what should investors be expecting from the Fed? I want to bring in my contributor for the hour. We've got Steve Sosnick, who is the Interactive Brokers Chief Strategist. Steve, great to have you back here in studio.
Great to be with you, Brad.
Let's talk through this. What should investors be prioritizing as we go into the back half of this year, kicking off with everything from trade deals that are anticipated to continue to be negotiated, hopefully netted out in some form or another. Also, a Fed that is trying to be looking through and be data dependent as we get this week of economic data on the jobs front that they're paying close attention to. Oh, yeah, and then earnings season starts in a couple weeks.
Let's try to lay them out, in terms of chronological order,
Sure.
and I hope I can do this correctly. We've got job numbers, as you mentioned, on Friday. Market's always looking to them. The jolts were a bit of a jolt this morning. I think that's, that works against the concept of labor market weakness, but we'll get a clearer picture on Thursday, I should say, not Friday, because it's the holiday. In theory, the budget bill should be signed at some point, but there's the back and forth. I don't, talk about the not wanting to see the sausage being made, but there's a lot of stuff going on behind the scenes. It's too difficult to figure out exactly how that shakes out, but I think the basic framework is there. Then we have the tariff moratoria next week.
Right.
Do those expire or do those get pushed back again? Again, the market seems to be looking through that and thinking that this will all be fine, there'll be deals done, or at least there's enough negotiations to give cover to the idea that they'll be pushed back. So that's there. Oh, and then guess what? It's earnings season all over again.
Right.
It seems like we never left one, but we have that again. And one of my fears is some of the stocks that we've seen recently that have beat on top line, bottom line, and guidance, and then still get whacked. We saw it in Progress Software today, and we saw it in Micron a couple weeks ago. That is a concern going forward. And then you've got lurking in the background is what is the Fed going to do? And Powell just said in the gathering of central bankers in Portugal that he doesn't expect any tariff effects to really be seen till the summer. So he's very much in wait and see mode. The market may be a little bit ahead of him by pricing in a full rate cut by September. But then again, markets have always been ahead of the Fed. Remember the 8 rate cuts that we were supposed to get in 2024?
Yeah.
So let's all see how this shakes out. So many moving parts, but yet we see a very quiescent market. VIX, 17-ish. Is not expecting too much right now.
As we're thinking through how the markets are looking out into the future and anticipating that all of these matters will come to fruition in some facet or another, it's just a matter of, for the checklist of trade deals, what those deals actually look like in the details as well. It seems like the markets are already kind of factoring in this effective average tariff rate of around 10% here, which is still well higher than where we began the year at an average about 2%. Jennifer Lee from BMO was reminding us yesterday here. Yeah. And so if the markets are already factoring all of this in, how far out into the future do you think the markets are looking past much of what is a headwind, at least as of right now, on a concern checklist for investors? I'm
actually going to take it the opposite way. The market is looking like, at itself. It's very self-referential right now. It's all, I categorize this as a mix of MOMO and FOMO. It's all about momentum and to a certain extent FOMO, of fear of missing out, which is why, you've got a relatively broad rally, but really the gains are concentrated in the stuff you'd think it's concentrated in. When I broke down the first quarter performance, basically S&P, and I broke out the SGX versus the SVX, the growth components of the S&P 500 versus the value components. The difference, the growth outperformed the S&P as a whole by about 8 percentage points. Yeah. The value underperformed the S&P as a whole by about 8 percentage points, which means the value underperformance was about 16 or 17 percentage points altogether. That's huge. That's telling you that all the action is in the growth sector. An SGX and NDX move essentially in lockstep because it's basically dominated by the same companies.
Does MOMO and FOMO mean that we're due for a prolonged melt-up in the markets from what your assessment is?
We're in the midst of a prolonged melt-up. Yeah. That's kind of what we're seeing. The question is, what gets it to stop? And you never really know what that is. I mean, this morning, did you have the president threatening to deport Elon Musk on your bingo card? No, and which is why we saw a little bit of red. That and the fact that yesterday's close was basically just pure window dressing. Yeah. But these are the kind of things. So that's why I looked sort of toward earnings season, because the idea of companies doing well and yet not getting rewarded for it, that's the sort of thing that gets in the way of a momentum trade.
Yeah, caught in a bad bromance they are right now. Steve, we've got much more to discuss this morning. You'll be sticking with me throughout the show, and we've got much more of the markets action straight ahead as we've now seen the Dow turn positive here to begin the 10 a.m. hour. Much more. You're watching Market Catalyst. Now time for some of today's trending tickers. We are watching Progress Software, Sweetgreen, Costco, and Lululemon. Let's get to it. First up, Progress Software shares lower as its results failed to impress despite topping expectations in its second quarter and raising its full-year outlook. The company also announcing that it is buying Spanish search startup Nuclea. I'm bringing back in Steve Sosnick, Interactive Brokers chief strategist, on this. This is one that you've been keeping tabs on this morning. Why?
Because this to me is very concerning. I'm not like hair on fire concerning, but what more could they have done to impress the market?
Yeah.
Right? I mean, you beat all, so, are we back in that world of like weird whisper numbers that exist sort of in people's minds that are not being published? Maybe, but when you get a situation where a company does everything that's expected of it and the market doesn't reward it anyway, that's a little bit of a concern.
It is, and it's really telling because especially going into an earnings season where you've already had some of the companies from last earnings season either need to provide a range of guidances, two separate ranges in the event of two separate outcomes that they could potentially see if they're more consumer exposed, or if the business spending environment deteriorates and gives them even more kind of cloudiness into that forecast and outlook. That's where if we get into some of these same conversations and we have less clarity, even though progress is coming out and saying, hey, yeah, we're actually comfortable raising our outlook, then what does that set up for the companies who are not able to provide some of that clarity? And that's a larger question mark, I think.
Well, that's a look out below moment if you can't provide it. Now, the April earnings season was kind of weird. Do you ever remember a situation where companies basically routinely said, we're going to throw the guidance up in the air, and the market didn't care?
Yeah.
Well, that's because we'd gotten so oversold, and the market was looking to move higher at that point because so much bad news had been priced in.
Yeah.
Now, so much good news has been priced in. Let's see if the market's quite so charitable, because I think some of the companies will still not be confident in offering too much guidance because for the reasons we discussed in the prior block of just lack of clarity on so many levels. But will they be able to get that pass again? Because of all the various moving parts that are out there.
Yeah. In summary, a lot of companies over the last earnings season probably could have just sent out a Larry David GIF. Next up here, Sweetgreen under pressure after TD Cowen slashed its ratings of the stock to hold from buy and trimming its price target to $15 a share. The analyst saying that he expects Sweetgreen to trade at a lower multiple as it expands into unproven geographies. Shares of Sweetgreen, ticker symbol SG, they're taking a little bit of a hit this morning. They're down by about 5.25%. And taking a look at the longer term price action that we've seen here over the course of this year, it's down 56% year to date. And it's interesting, especially tracking the lunch trade, if you will, and trying to get a sense of where Sweetgreen is netting out some of the thought process around new geographies that they want to move into. These are more data-dependent businesses. They can look at ticket size, they can look at checked ingredients that are resounding within certain regions, and then use that to make sure that they're working with their partners to really identify which menu items are going to do the best in those regions as well. So it's really interesting to see the analysts now come out and say, okay, we're not too sure that this is going to be a great strategy going forward. Some wait and see, if you will.
I think with almost any food company, you see this. They get hot, and the market kind of gets excited about them. And then what do you do in that situation? Of course, as your management, you're going to try to expand, but that's, getting that market share and expanding into new territories is tough because do you do it slowly? Do you do it quick? Does the market want you to do it quickly, but do you think it's better to do it slowly? This is the growth pain you have with pretty much any of these type of relatively newer food, big food companies, big quick serve restaurants.
And it's also interesting to see the move in Cava here today as well. Also year to date down by about 28%, but also perhaps with some of the thought process rattling around Sweetgreen and the lunch trade, Cava also moving down by about 2.25% here on the day as well. We also want to track this one. Lululemon suing Costco, claiming that the wholesale retailer is selling a dupe of its athleisure clothing. Lulu claiming Costco, quote, unlawfully traded on its reputation, goodwill, and sweat equity by selling unauthorized and unlicensed apparel, employing knockoff, infringing versions of its clothes here. And taking a look at shares of Lululemon, they're up by about 2.25% on the day. Costco down by about 0.4% on the day. Look, I'm sitting here chuckling. I see you chuckling out the side of my eye because at the end of the day, Costco is really putting forward some efforts. And I won't go as far as to say that they're just straight up copying some of these other companies, but it looks a lot like it. You think back to what the Kirkland golf clubs did, and TaylorMade basically came out and said, wait a minute, these are the exact irons that we create already, just as Kirkland on them. So I think it's interesting for Costco really being able to capitalize on this moment that they do have with the foot traffic. But of course, if you're going to catch the attention of some of these major companies, you better be able to prove your case as to how you are not infringing on them too.
Yeah, I'm going to say that I'm not particularly expert on yoga wear, particularly in whether it's Costco or.
Oh, come on now, the unicorn tears. You don't have that stocked up in the closet at home, Steve?
No, I'm old school. I'm old school shorts and t-shirt guy.
Fair enough.
But Costco is a juggernaut, and as you say, I guess a lot of times they go close to the edge. I have no particular opinion as to how this is going to be resolved, though. I can't offer anything intelligent to say.
That is something that they pay very well, some of those lawyers for.
Exactly.
So we'll see how that nets out. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. President Trump reiterated threats to cut government subsidies to Elon Musk's companies Tuesday morning after the Tesla CEO criticizes his mega tax and spending bill.
We might have to put DOGE on Elon. You know what DOGE is? DOGE is the monster that might have to go back and eat Elon. Wouldn't that be terrible? He gets a lot of subsidies, Peter.
Musk previously called the spending bill insane in a series of posts on X, floating the idea for an alternate political party. The escalating feud comes as the Senate's vote-a-rama is still underway Tuesday morning following an all-night session here. Joining me now to discuss, we've got Washington correspondent Ben Werschel. Ben, I don't know where you want to begin. There's a lot to digest there, but let's start with Vote-a-rama, perhaps.
Yeah. So Vote-a-rama. So we do have some news on that just in the last few minutes on the Vote-a-rama. As you saw on that footage there, the Senate is still voting on that, but we do appear to be close to a final vote. John Thune just told reporters a few minutes ago that we could be moving to the final vote stage in the next hour. And the hang-up here has been over healthcare issues. This has already pushed what we would expect to be 2 Republicans into the no column and a series of last-minute negotiations with a third, Lisa Murkowski of Alaska, over these cuts to healthcare that could take about $1 trillion out of the healthcare sector in the years ahead. It's gotten a lot of objections. There does appear to be, at least kind of from the body language experts watching Murkowski live negotiate on this on the floor, there does seem to be some sort of concession there that's going to work with Republicans increasingly confident just in the last few minutes that they're going to have a vote just in the next few minutes. And so this would advance the bill through the Senate and where it heads to the House, which could start considering it as soon as this afternoon if there is indeed a deal here as they sprint to try to get this to Trump's desk.
Something else you've been tracking, Ben, that I wanted to drill further into, an AI provision was removed from the tax bill. What can you tell me there?
Yeah, so this was part of this Vote-a-rama process that we're about 2 days into, and this seemed to be a provision that was, as of yesterday, was kind of on a glide path to passage. The issue here is an idea to ban states and localities from regulating AI, basically leaving the whole issue to Washington. That raised a lot of objections, but there seemed to be a concession. There was going to be not a full ban, but only for 5 years. But last night, Marsha Blackburn is the key senator here from Tennessee. She announced she was opposed to this compromise deal, and she teamed up with a Democrat to amend it. So that part is out of the bill. There's a lot of support for this in Silicon Valley. That's gone from the bill now. That passed at about 4 a.m. So that's going to be gone as part of this larger package on taxes, healthcare, the border, all these other issues.
All right, Ben, while we have you as well, and Steve brought this up a moment ago, who among us had DOGE coming back to bite Elon Musk on our bingo card and Trump talking about deporting him this morning?
Yeah, for sure. This is another kind of wild night. This all was happening in parallel. This is another piece of this bill that we haven't even talked about. I think the clean energy piece. This is Musk's big objection here is provisions of the bill that really did tilt in the last few days and really set Musk off, as well as a lot of other clean energy experts, around basically what is headwinds, not just no government assistance, but headwinds, active headwinds for the solar industry that they could feel in the years ahead. Critics are calling this basically a surrender on clean energy and a move to fossil fuels. And it clearly, Trump and Musk are even further apart now on this issue and a lot of others.
Ben, good to see you this morning. Thanks so much for continuing to track all of the developments on this. We'll check back in.
Mm-hmm.
Steve, I want to pivot and get your thoughts on the bill. Is this a tradable event for investors, and how would you rank this in priority of portfolio positioning and how traders should be thinking about it?
Well, I think a lot of it has to, I'm going to take my cues largely from the bond market on this one, because what I fear, it would be a real steepening of the yield curve. We saw the 10-year perform pretty well into quarter end. Bond traders are not immune from window dressing either. We do sort of see bond moves kind of culminate around quarter ends a lot of time. Yeah. And if there are real concerns about the sustainability of the debt and deficit, you would see that reflected in higher 10-year yields relative to shorter rates. I think I just saw a headline go by that Powell is concerned about the sustainability of the debt under the new deal, under the new budget deal. And so that's what I'm watching, because you're also seeing a lot of times where the dollar is selling off even as rates are slightly higher. All things being equal, a higher rate should help a currency. And the US actually has relatively high rates compared to the rest of the world, but yet the dollar had one of its worst halves in decades. Yeah. And so it's telling me that money is sort of leaking out of the US, whether it's stocks or bonds. That's why I look to bonds, because if they're starting to freak out, then we kind of have to worry about the sustainability of the deficit and the debt.
That's so fascinating, and what you were mentioning in money leaking out of the U.S. at the same time where you have the administration that is touting some of the international deal making that, as we were watching the international trip that President Trump took to the first one of his Trump 2.0 presidency, talking about where there are some of these major entities, organizations, both on the private sector side, that are trying to get into certain regions of the world, and those regions of the world that are looking to invest in the U.S. All this considered, we're still looking at some of the record high exposure that foreign countries have to U.S. bonds right now that I believe we're still sitting at. So, just help us make sense of that. Why is it either net good or net bad if we did see some of that international holding of U.S. bonds right now?
Our biggest single export is our debt. Basically, to put it oversimplification on this, sure. we buy stuff from the rest of the world, and they buy our debt to finance this, because our savings rate is not particularly good in the U.S. So we buy stuff from abroad, and it's sort of to balance out the equation. Sure. They buy debt. The problem is it doesn't take much. If there was just even a marginal decline in the amount that they're willing to refinance or continue buying, that would get hit, because I don't know that there's the domestic demand with which to replace that. In theory, if the trade deficit starts to come down meaningfully, we don't need to replace it as much. But then if the actual budget deficit goes up, then we do need to replace it. So there's a lot of moving parts. Bottom line here is, the stuff that was mentioned in that Middle Eastern trip were long-term investments. They're going to play out over a lot of time. Refinancing government debt plays out continually. There's auctions almost constantly. So I'm not going to say that some of these countries are going to do anything, to really be spiteful. I mean, if China wanted to cause a little bit of short-term chaos, they could just sit out a bond auction one day and all of a sudden, watch the chaos that ensues. But it would hurt them as well, because they own so many. They and the Japanese own, trillions of U.S. dollar debt collectively. And so I don't think there's not a high risk of it, but trading occurs at the margins. And so if you see marginally less demand, it does have an effect on prices. In the case of bonds, prices go down, yields go up if people sit out.
Look, we could continue to talk about this. We fortunately do have more time to talk about this, Steve. Thanks so much for breaking that down. We've got much more markets action ahead. Stay tuned. You're watching Market Catalysts on Yahoo Finance. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, we've got Brooke DePalma. Hey, Brooke.
Good morning, Brad. 1 hour into today's trading session, and excitement has cooled down just a bit here at the NASDAQ after we saw those record highs on Monday. Taking a closer look at all three major indices, we have the Dow Jones Industrial in the green this morning, ever so slightly up 0.6%. Taking a closer look at the NASDAQ, really moving lower after once again hitting that record high on Monday, now moving slightly lower in today's trading session. Taking a closer look at the S&P 500, a similar story there, down roughly 0.1%. And what we're really seeing here is that looming July 9th deadline really be on top of investors' minds. That was a deadline that President Trump had imposed during Liberation Day back in early April. We currently know that the EU is negotiating a 10% tariff on exports to the U.S., but it's looking to exempt key sectors like pharmaceuticals as well as semiconductors and aircraft. We also have Japan currently in trade talks with the U.S. after Trump has threatened to pass along higher tariffs because of what he said is Japan not accepting U.S. rice exports. So certainly keeping a closer look there. Also taking a look at the 10-year T-note, which is currently really seen as investors seeking out safety in this market as they weigh potential investor fear. That's currently up 0.5% and really has been up in the past 5 days, moving lower overall, but slightly higher today. And we're currently keeping a read on some really engaging headlines from Fed Chair Jerome Powell. We saw him say that tariffs was really the reason that they have been taking a prudent wait-and-see approach to interest rates. They're waiting to learn more. He also said that they expect higher inflation this summer because of those tariffs. And another headline as we await the voting of that big, beautiful bill from the House today. Fed Chair Jerome Powell saying this morning that debt path is not sustainable and will have to be addressed sooner or later. He said that inflation is really behaving exactly as we expected and hoped as well, but certainly tariffs, the key lookout here as that July 9th deadline looms of what exactly the implications could be here on inflation and overall prices as we edge way into the summer.
Brooke, thank you so much. Live from the NASDAQ. Appreciate it. Japan's Nikkei index ending the day lower after President Trump threatened to raise tariffs on the country as negotiations stall, blasting Japan on social media for refusing to import U.S. rice despite a shortage. We also got White House National Economic Council Director Kevin Hassett also signaling that agreements with several governments will likely be announced after July 4th. I want to bring back in Steve Sosnick, Interactive Brokers Chief Strategist here. Were we really expecting for some of the purchase decisions to be made at this juncture? And what is the, I think this actually gets to the question of how difficult it is to actually police follow through of some of what gets netted out in the trade negotiations here as well.
I think they sort of pick and choose to some extent. So the digital services tax was one that really, was under the government's skin. Probably no coincidence that a lot of the people who run companies would be most affected by that or, have the president's ear. As far as Japan and rice, I have spent a lot of time in Japan. And while we're tariffing all kinds of things that we believe to be strategically important, such as steel, such as shipbuilding, et cetera, there's nothing more important to the Japanese psyche than rice. And so they do protect their rice industry for the reasons that various countries are protective of certain key industries. And we do the same thing. So I think it's, picking on that while raising the tariffs on certain other things that we perceive to be strategically important is a bit, shall we say, inconsistent. But that's, I guess, part of the president's negotiating style is just to, hammer on what he sees as somebody's weak points or someplace that he feels is advantageous. They do import a fair amount of rice from the U.S., but again, they are very protective of their domestic rice industry.
As we think about some of the markets and the international exposure that investors were told to look for at the midpoint of the first half of this year, as we're thinking through some of the markets that are presenting the largest opportunity, are any of the countries that we're actually negotiating trade deals with right now presenting those opportunities? And I think about the growth projections that we had seen over the past few years with countries like India throw China in there as well. As much as there is sparring and wanting for the U.S. to continue to maintain GDP dominance, it's still a matter of, okay, where is there an investment thesis that actually supports growth that could actually help your portfolio at the end of the day?
Well, international investment, investing internationally has been a big winner for the most part. Again, we talked about the dollar being lower versus most major currencies. So you've gotten a tailwind if you've been investing elsewhere because you are de facto exposed to other currencies. On just a strict index basis, the Nikkei in the second quarter actually outperformed the NASDAQ.
Wow.
People don't necessarily catch it. Now, year to date, it was an underperformer, but at least in the second quarter, it shot up. It was up about 20% or so, and that's before any currency effects. Year to date, the best performers have been things like DAX and the Hang Seng.
Yeah.
They're both up about 20% year to date. Again, better than NASDAQ and Hong Kong. The dollar, their dollar is fixed against our dollar, but the DAX is the euro. So you've got, and this is in spite of a much stronger euro because that was. They've doubled down on defense and other heavy industry, largely in response to our president sort of, his commentary and about defense and things like that. Sure. So that's propelled those markets. So they've got a lot of momentum too, and a lot. Again, if the dollar keeps weakening, that helps you as an investor in a foreign currency. It doesn't necessarily help those markets. That's been actually, the weaker dollar has actually been a bit of a help to the U.S. at some point because it can help the comps when the earnings come out.
Some really valuable context. Steve, stick with us. We've got a little bit more to discuss here. Everyone, on the other side of this short break, we've got much more of your markets action. You're watching Market Catalyst. It's time now for our chart of the day, and we're looking at expected moves in the market on Jobs Day. Projections from JP Morgan show the S&P 500 rising in most scenarios around the jobs report. So let's break this down, because you can see here, if we get 145,000 or more jobs, they're forecasting a 5% probability of a 1% to 1.5% gain. That's in the S&P 500. Now, if we saw between 125,000 to 145,000 jobs, there is a 25% chance of up to 1.25% gain for the S&P 500. Now, the data showing a gain for the S&P 500, so long as jobs come up above 105,000, below that, we are looking at slight declines here. So there you're taking a look at some of the probabilities of this playing out and then the expected move. And here's what's also on investors' minds, especially as they're weighing through a myriad of different data prints on the jobs and employment situation front over the course of this week, as we had already gotten jolts out earlier today. And we're still going to get ADP private payrolls. The larger question going forward for the employment situation is, are there enough areas to signal to the Fed that there is severe weakness that forces them to act prior to September? The market's still looking for about 50 basis points of cuts going into the end of the year. And with that set to kick off in September based on some of the analysis and probability on the CME Fed Watch, well, that would mean that they would need to lock in a trend over these next few reports, and going into their July meeting, they would have to change that tenor a little bit more aggressively, perhaps. But we're also got fresh commentary from Fed Chair Jay Powell, who's speaking overseas in Portugal today. And it's not just the employment situation that he's focused and locked in on. It's also what could impact the economy more broadly and on a more longer term scenario, and giving some slight commentary on the tax bill that's also making its way through Congress right now. So all that said, we're going to be locked in Thursday this week for some breaking data on the jobs front with the employment situation. Well, job openings increasing unexpectedly in May, rising to a 6-month high at nearly 7.8 million openings, suggesting more confidence in the labor market ahead of Thursday's jobs report. While U.S. manufacturing remains somewhat sluggish in June, suggesting President Trump's tariffs are having an impact on business. Manufacturing PMI rising to 49. So some improvement from the prior month, but we're still seeing that gauge below the 50 mark, indicating contradiction. So or contraction rather. So here to discuss what it all means for the U.S. economy, we've got Paul Grunwald, who is the S&P Global Ratings Global Chief Economist here. Thanks so much for joining us on set
Good to be
today.
back.
Absolutely. Also with us for the conversation, we still have Steve Sosnick of Interactive Brokers. So as we really think through the data that we've seen come through and whether or not it's starting to line up in a trend fashion that would then pivot the Fed or at least get them firmly into cut camp, are we close, or how many data points away from making that trend are we in your reading?
Yeah, we think July's probably too early for the Fed to make its next cut. They'd have to see some bad employment numbers and then some weaker inflation numbers. And our baseline still got this gradual slowdown in the U.S. this year, but we don't think they're going to be ready to flip the switch in July, at least what we've seen the last couple of months. But as this morning's data show, we're still a little bit in this bouncy area where things are a bit all over the place.
So Steve, does that set us up for September then?
It could, assuming that we know what's going on in terms of tariffs and we know what the budget effects of the deal are going to be. It sounds like certain members of the board are a little trigger happy. Others are not. Powell seems not to be. Bostic's not voting, I think, this time, but he seems not to be. So there's mixed commentary. Again, as I mentioned, the market tends to get ahead of the Fed a bit. But I'll leave the real underlying economics to Paul.
And when we think about those underlying economics right now, where is the Fed seeing the most area of concern at this juncture, especially as they're hearing from everyone from President Trump chirping at Fed Chair Jerome Powell, all the way through to some of the major investment institutions that are saying, okay, yeah, now we're starting to think that they should be cutting as of
well, the big issue is the uncertainty. It's not, as we've said, it's not really the tariffs themselves. Those are a negative issue, but it's really all the uncertainty around tariffs. We've got another date coming up on July 9th, which is the pause on the April 2nd tariffs, and we just don't know what's going on. And when people don't know what they're going on, they slow down investment, they slow down spending, they slow down capital allocation, they slow down M&A. So we've still got this overhang on the market. And we'll see what happens on July 9th. We heard some noise about Japan this morning, but as long as that overhang is there, we still think we've got to sort of dampen sentiment everywhere, basically.
I want to stick with you for a second, Paul, because I was taking a look at one of the notes from Apollo chief economist Torsten Slok this week. It said when FOMC members produced their forecasts ahead of Fed meetings, they are also asked how they view the risks to inflation and unemployment. And one of the net takeaways that this is a Fed that is worried about stagflation right now.
Yeah.
Why is stagflation now one of the core worries for the Fed, and to what extent are we placing probability around the reality of stagflation playing out?
Yeah, we're not really in the stagflation camp. We are going to get a rise in inflation rates because the tariff's going to lift the price level, but that's not really a driving force on inflation higher. So I think we're still in this kind of traditional world. The signals are very noisy, right? Because you are going to get a rise in inflation and a rise in unemployment, and that's kind of stagflation. But we think we're going to look through, and the Fed's probably going to look through the jumps from the tariff versus any underlying inflation trends. We still think the next rate's down.
How can investors position their portfolio if we did see stagflation play out? What are perhaps the stagflation positioning in a portfolio?
Stagflation is kind of like the worst of all scenarios.
Yeah.
Now, I'm with Paul. I think technically, if you're looking at higher prices and a slowing and a stagnant economy, that's stagflation. But I think when the term gets thrown around, we're nowhere close to what true 70s style stagflation is.
Yeah.
And correct me.
Can I jump in on the back of that? And the other thing we're seeing now, the positive thing that we didn't see in the 70s, is productivity growth. Remember, the last couple of years, U.S. has been hitting the ball out of the park relative to the rest of its peer group. Strong productivity growth, strong new business formation. So that's not a recipe for sort of supply side, weakness. That's really a stagflation issue. So I don't think that's really on the table right now.
You talk about that productivity growth, and one of the questions that we've had for several jobs readings now, perhaps for a couple dozen, is where we might see AI start to show up within that productivity growth as well.
Yeah, that's kind of a big, even economists, even really smart economists, have got this huge range of outcomes, right? The current Nobel laureate's close to zero for the effect of AI on growth.
Interesting.
Some of the more, bullish guys on the street are 1.5% increase in growth over 5 years. Some of the, the IMF, OECD are in the middle. We just don't know. We know it's positive. We don't know when it's going to show up in the data and for how long it's going to last. But it's got some potential I wouldn't be watching kind of the month-to-month, labor market data to see if we're going to see AI. I think it's just a longer-term kind of trend thing, but definitely positive.
Even if positive for productivity, is it still positive for overall headline jobs growth?
Yeah, well, that's the thing. You can have productivity go up by hiring fewer people or expanding the pie and hiring more people. So that's the big thing with the AI. Productivity is going to go up, but is it labor enhancing or labor substituting? It's probably going to be a little bit of both. We're going to have to tease those out. But again, that's a multi-year thing. That's not we're not going to know the answer to that by the end of 2025, right?
Look, we just want to know all the answers all the time.
I know.
That's why
I'm sorry to disappoint you, Brad. Paul.
Great to have you here. Never a disappointment at all here. Thank you so much for joining us in the studio. Steve, thanks for chiming in the conversation as well. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Market Catalyst. 2025 has been a wild ride for bank stocks so far. An index tracking the banking industry has recovered nearly all of the ground lost back in April, and it's now near its February highs. And joining us now with a closer look at the factors driving the industry, we've got banking reporter David Hollerith. David, what do we know here?
So Brad, U.S. bank stocks have kind of performed like the broader market indexes, after seeing February highs. Sort of peak fears happened in mid-April, tariffs and recession fears. And since then, things have gotten a lot less stressful. There's also been this kind of like ongoing or growing, I guess, narrative about deregulation in the banking sector, and that's really kicked off in the last week or so. So I think investors are feeling pretty good going into earnings. That being said, some bigger banks are already sort of at their peak prices, and the investment banking market is still not quite what was hoped at the beginning of the year. So that's going to be something we'll be paying a lot of attention to in mid-July.
And also, last week, 22 of the biggest U.S. banks, they also passed their annual stress test. I mean, this was a big deal, and it's a stress test by the Federal Reserve. What does that mean for the industry more broadly here?
Yeah, so I mean, it means that the banks are well capitalized, which is obviously crucial. So this is one part of bank capital structure, and that's the amount of money they have to set aside, basically, in case of potential losses in a market shock or something like that. So them passing the stress test last week is kind of the latest data point for the current administration's kind of push to maybe pull back regulation, which has kind of been increasing since the Dodd-Frank Act was put into place after the financial crisis. So we're kind of seeing the beginning of a pendulum swinging away from regulation to more of a deregulatory stance for banks.
Yeah, as you're thinking about what we're anticipating to hear from banks this upcoming earnings season, what are you expecting that tone to sound like from some of the leaders of the largest major financial institutions here in the U.S.?
Well, so they're going to be very careful about framing the deregulatory story because they, for their part, they feel like they've been way too regulated and they hold way too much capital for years. So they feel like it's more than justified. So that'll be how they approach the regulatory standpoint. They're going to be hoping for bigger changes in their capital requirements. They're also going to want to be sort of talking about the investment banking landscape and their expectations for green shoots, as there often is in the second half of the year. And we're still waiting to see the effects of tariffs once they hit. So that's obviously going to be a big one. And Jamie Dimon, the CEO of JP Morgan Chase, which reports first, will definitely touch on that.
He's had some interesting commentary recently, too, around the average effective tariff rate that they're anticipating. On that front, I mean, are we expecting another kind of major, dare I say, kind of meteorological moment from Jamie Dimon, especially considering the mix of factors that investors and his own staff are considering right now? Everything from deals that are working their way through Washington, D.C. in the form of tax bills, and then additionally in trade negotiations that impact how he's looking through that average effective tariff rate as well right now.
Yeah, it's a really good point, and I'm sure, I have no idea what the calculus is going to look like for that, and Diamond does actually a really good job of kind of laying it all out in pretty simple language. Yeah. But the interesting thing here is that he doesn't try and predict and be correct as much. He tries to be one of the biggest worriers, and that kind of speaks to just how banking is so fragile because banks are so leveraged. Period.
Right.
So.
He's got a lot of things to take into consideration, and to your point, they have a finite amount of space within that press release to actually do it. They do a good job of it. David, thank you so much.
Thanks, Brad.
Appreciate it. Coming up, everyone, we've got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. You hear the music, you know what time it is. 90 minutes into the start of trade, and I'm Brad Smith. Let's get to a check of the markets here as we are kicking off the 11 a.m. hour of Market Catalyst. Taking a look at the major averages, we've got them loaded up here for you on the screen so you don't got to do any searching at home. Dow Jones Industrial Average up 0.5%, 0.6%. Why not keep going higher? Anyway, it's up by 0.6%. Fractional gains right now after starting the day off in the red. Taking a look at the S&P 500, you're seeing that start the day off to the downside, and ultimately 90 minutes into trade, we are down by about 0.3% right now for the S&P 500. It does come during a week, a holiday abbreviated week as it may be, where we have already seen some new all-time highs for the S&P 500. And the NASDAQ composite, you're seeing that down by about 1% right now. We're going to take a look at some of the activity that's transpiring over the course with a deeper dive into the interactive right now. Let's start, as we always do, with some of the sectors. 11 S&P 500 sectors, got them loaded up here for you on the screen. Don't adjust your television screens or your smartphone screens, however you're consuming Yahoo Finance here today. Technology is down right now by about 1%. XLK is pulling up the caboose. However, leading the pack, take a look at XLB Materials. That's up by about 1.6% right now. Looks like we are about as split as you can get for 11 sectors. 6 of them are in positive territory, and overall the index is still down by about 0.3%. Also, taking a quick gander at the NASDAQ 100 here, NVDA, it is down today by about 3% here right now. And as we're continuing to track some of those other Mag 7 players, take a look at Apple. That is up here by about 2%. One of the other things contextually that we want to put in view for you here is the year-to-date action, though. Still down 16% over the course of 2025 for Apple. How rare is that you can have a market that's hitting new all-time highs and Apple is not a major catalyst or participant within those new highs here, especially as the S&P 500 getting back into positive territory and getting back to all-time highs is one of the major considerations that traders have been talking about going into, of course, the holiday weekend. Of course, we've got a couple sessions and a few pieces of economic data until that point. And then just lastly, here's a look at the Dow 30 components here. I'll put this on an equal view. Looks like we have more gainers than laggards, and yes, indeed we do. Woo, the swoosh. We were just talking about the Kobe Dodgers shoes that came out not too long ago. I was with Steve Sosnick and one of our guests that's about to come up here. I'll introduce him in a hot second. But there you're seeing the brand of the swoosh. Lower year to date by about 3%. But here on the day, it's up by about 3.4%. And this is one critical point. Earnings, that's what you can tie that back to, and that move back to the upside here. Still got a little bit of room to go to get back into positive territory for the year, though. Well, coming up this hour on Market Catalyst. First up, we look at the artificial intelligence trade as trading for the second half of the year. It kicks off on Wall Street. Happy July 1st, everyone. Plus, the tax bill debate continues in Washington, D.C. We bring you the latest headlines with Treasury Secretary Bessent saying he expects the bill to pass today. And we break down trades and the risks as the deadline, it does loom here to make some of those deals in Washington. All that and much more coming up on Catalysts. Well, let's talk a little Meta. Down this morning after hitting a record high during trade on Monday on enthusiasm for its revamped AI efforts. In an internal memo, Meta CEO Mark Zuckerberg reportedly announced Meta Super Intelligence Labs will be led by former Scale AI CEO Alexander Wang and former GitHub CEO Nat Friedman. In the first half, Meta's gains outpaced chipmaker NVIDIA and the MAGS ETF, which tracks all 7 mega-cap tech giants. For more on how to play the AI trade as we enter into the second half of the year, I want to bring in Shay Bolar, who is the Futurum Chief Market Strategist. Good to have you here in studio with us.
Thanks for having me.
Well, you were the person that we were discussing the Kobe shoes with the Dodgers edition. Of course, you're a native of LA, but all that considered, let's talk a little meta here for a hot second. As you're thinking through some of the accelerated investments that they're making to catch up and further entrench themselves perhaps in some of their AI ambitions here, how are they measuring up against what they've already told and sold to investors at this juncture?
Yeah, I mean, first off, as a fellow Angelino, I'm really jealous of the kicks you were able to get. So maybe I got to pair it back at home. But for Meta, I mean, let's just do some back of the napkin math. Like, it's roughly a $2 trillion company. If they fall behind in the AI race, 25% haircut, that's $500 billion. So if there's any kind of hint from Zuck that Meta's falling behind, Llama 3, Llama 4, there really isn't that much of a improvement, he's going to reinvest to get that AI talent because something that Scale AI has is data labeling, and that's something that OpenAI, Google uses them for. So he was able to do this shadow acqui-hire in order to get Alexander Wang under the hood as soon as the following week, and also damage his biggest competitors because now they're going to have to drop Scale, and now it's going to be all under Meta's roof.
One of my favorite things, and we were talking about this in the newsroom before the show among our team, is seeing these announcements of new core and key profiles that are making moves from like OpenAI to Meta, almost as announced as if they are picks in a draft or as if they are NBA or NFL players here. It's been remarkable to watch, but it speaks to how valuable this talent is that's going into different behemoth and mega cap tech stock type of companies here for Meta and what they're building out and how that can play out for consumers. What does that timeline look like for your assessment?
I mean, it's funny you made that comparison because this week was the NBA free agency started. Exactly. It felt like the AI free agency is beginning right now, and Meta even dropped the roster of the talent they were able to get, and there was a hype behind it because this race is just beginning, and we believe at Futurum Equities that there's going to be multi-trillion dollars of spend in the next couple of years. And in order to do so, you need the biggest AI brains creating these products. And as a consumer specifically, there's going to be, models are going to improve rapidly. There's an abundance of them out there now. So because there's an abundance of models, there's eventually going to be a production boom, and consumers are going to benefit from that. And I still don't think we really experienced the middle innings of this game because agentic AI is just kind of getting started. Yeah. And the ChatGPT moment for agentic AI hasn't happened yet. So as soon as the first company solves that next wave, I think we're going to get a better sign of who's going to be the winner in the super AI intelligence, because that's what all the hyperscalers are racing towards. Who will be the super AI intelligence winner?
Steve Sosnick, Interactive Brokers, you've been on set listening into this conversation. I want to get your take, especially knowing that what we were breaking down at the start of this hour is you have a market that's gotten back to new all-time highs for the S&P 500, for the NASDAQ 100, and that is without the participation of a company in Apple. As this AI trade is playing out and the poaching that's taking place that we've been talking about and the building out of some of these apps, these learning models, what is the significance that it's a Meta that's driving some of this versus an Apple that has really been the player that is the kind of the core keystone to some of the moves higher that we had seen in previous market cycles?
Well, there's a lot to break down in there. I mean, first of all, there's this huge spend that Shay just referred to. Now Meta has done this before where they've spent billions of dollars, metaverse, and and sometimes it works, sometimes it doesn't. I think they don't want to be left behind, and I think there is more opportunity here. But that's certainly, something to be considering. As far as Apple, Apple's been a bit, I hate to say it, but Apple is it's a growth stock that doesn't grow very much. And I think the market's kind of catching on to that. There was a period there where Apple was basically stagnant for a while. They have picked up, sales and earnings growth again. But at some level, the market's got to make the decision, is Apple a value stock, the most expensive value stock, or is it the cheapest growth stock? And right now, I think the market is kind of starting to view it more as a value stock. They have this hoard of cash that they could be doing these same free agent acquisitions that Meta is doing, literally their biggest free agent who got away, Johnny Ive, got a huge deal with OpenAI now. Right. So they're sort of. They've got this great platform where billions of us are tied into it, but they're not the innovating kind of company that they have been.
Shay, what do you think for Apple and how they have been largely regarded as missing the mark or missing the moment, at least to this point, in the AI, just the thrust forward of capital that's going towards some of these initiatives and the reception on the user side as well?
I mean, they're just not a growth company anymore. I think whoever believes that they are believes that they're going to be creating the ambient AI assistant for the world in the next 10 years. But in order to do that, you need the talent. And I think Apple has a difficult time attracting this talent. Zuckerberg, he has a reputation. Everyone wants to work with him. Same with Elon. XAI and Meta can attract AI talent that Apple just can't. And I think that might be the hurdle right now for Tim Cook maybe, and that's why they probably have to make the pivot on, we got to outsource our foundational model. Like we have to pair up with OpenAI or Perplexity because we can't solve it in-house. And the risk of falling even more behind in this AI race just isn't worth us building it internally. So I think that Apple is in kind of awkward middle ground where they're 30 times earnings, they're not growing enough, they're not having this consumer AI narrative. And I think they're, at the end of the day, they're going to be just fine. Like we said, 2.4 billion devices worldwide.
Right.
But they're going to be a financial engineering company going forward.
And to that point, they've got the devices, they've got the hardware. How much more difficult does that then become for Meta to ensure that they also have hardware to pair with all of the artificial intelligence, generative AI, all of these features and applications that they're bringing to market as well?
So I do think that Apple's building or innovating in a old hardware world. Hardware is going to change. That's why you saw OpenAI make that splashy acquisition to get the person who created the magic behind the iPhone in-house in OpenAI. So I think that there is a risk that they might become the next Intel, because Intel was a powerhouse in the computing era. They were. Nobody thought they would essentially go down for the next couple of decades. Apple might fall at risk because you never know what the new age of device is going to be. It's not going to be scrolling. It's going to be pure intelligence. I'm going to verbally say something. I'm getting a response, and it's going to change my action right away. I think the days of, like my grandkids, they're going to look back at me. What do you mean that you had to click an app, scroll, and type? You didn't verbalize everything? Like, I think there's a world where this change might be happening quickly. And there is a danger that if you're an Intel shareholder the last 20 years, like, you know, the PTSD of like believing in an old narrative when the environment's moving so quickly. And this is the first time in history we have multiple super cycles happening at the same time.
Yeah.
We have AI, quantum, robotics, physical AI. Physical AI is a great avenue. I don't know why Apple's not going all out at physical AI. That feels like the next derivative of their hardware innovation. Like, everything in-house is Apple. Apple phone, Apple AirPods. Like, I'm talking bad about Apple, but I use 5 of their devices. And I think physical AI is going to be as applicable in everyday life, probably $15,000 a family in like 5 to 7 years. Apple should own that space, connected to the Siri, Apple TV, etc. I think that's kind of where their North Star should be. And maybe pairing up with an Anthropic, OpenAI for their foundational model helps control their stack better for that vision. That might be the case, but Apple doesn't reveal their secrets, so everyone's just sticking their finger in the air and seeing where it blows.
We apologize to anybody's Siri who we just activated here. Shay, great to have you here on set with us.
Thanks for having me.
Thank you. We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Let's go live to the NASDAQ to get a read on the best and worst performing sectors in the market today. Joining us now, we've got Brooke DePalma. Brooke, break it down for us.
Good morning, Brad. As we make our way roughly 2 hours into today's trading session, the excitement is easing just a bit here. If you take a closer look at all 3 major indices, we have the Dow Jones still in the green, but the S&P 500 and the NASDAQ certainly moving lower in early morning trading here. And certainly if you take a closer look at that NASDAQ, the run that we've seen over the past 2 days as they hit a record high closing day on Monday, now that's pared back a bit as investors really do try to seek out some safe havens in this market. If you take a closer look at the heat map here on the YF Interactive, what's really leading the charge here is those materials, as that possibility of inflation is rising due to tariffs and the impact there, also what it can mean for commodities. We're also seeing healthcare and consumer staples really make moves up nearly 2% in this market as investors seek out stability, moving away from what we saw do really well on Monday, including tech and communications. Also taking a closer look at the NASDAQ, one in the green here is Apple, as they're considering using AI technology from Anthropic, PBC, or OpenAI to power a new version of Siri. And taking a closer look at the Dow, we're also seeing those consumer staples do well. Think J&J. We also have Walmart moving higher, Procter & Gamble also moving higher. And another stock that I'm looking out for is also Nike. We're seeing a bit of a bump there after they got upgraded by Argus Research. So what we're really seeing here broadly is this move to safe havens in this market after we saw those all-time record highs hit the NASDAQ on Monday's close.
Brooke, thank you so much. Well, tech and communication services led stocks to new highs to close out Q2. Can we expect that dominance to continue? I'm bringing back in Steve Sosnick, who is the Interactive Brokers chief strategist here. Steve, as we think about some of the areas that have powered markets and the participation that we're still waiting for within this broadening, as we've already struck some of the new all-time highs for some of the major averages here, what do we need to look for? What are the kind of pillars to that broadening actually taking place and coming to fruition?
Well, the broadening would be, a little bit less focus on the pure momentum of these leaders and starting to look elsewhere. But we need to sort of break away. There's basically sort of two parts of the trade. We need to kind of break away from the most sizable companies leading the advance. We see it in big tech. You were talking about banks earlier. The big banks are far outpacing the smaller banks, despite the fact that regulatory reform was supposed to help the smaller banks more than the big banks. But we're so in love with big cap momentum. The other part of the trade is the pure speculation. I'm not going to call it. It's not quite the flight to crap, but there's a lot of it there. A lot of penny stocks and other strange names having big runs. We kind of need to see that middle ground pick up. We saw the Russell and the mid cap lag. They're, over the first half of the year, they were flat to slightly down, basically. And so we need a broadening market. We need a strong economy for that, though, because those stocks are more economically sensitive. What we see also today, though, is a little bit of what happens when the momentum trade goes bad, because a lot of the same people are piled into the same names. So you have Tesla getting the drawing fire from the president today, and that stock's down. It was below 300 at one point earlier. But we're now starting to see some drop taking in things like CoreWeave and Palantir today, things like that, where I think it's its own sector. These very highly speculative big tech names. But that draw, some of them big, some of them not as big, like Circle. But we find that they almost are a sector in and of themselves, the highly speculative tech names that are just favored by traders. There's not necessarily a great rhyme or reason to them other than that there's some underlying sexy story. And
so within that, the sexy story has just been that they're the new kid on the block. They're fresh into the market. They offer that speculative opportunity based on what they're putting in their S1 filing. And then it's a mindset for traders of, okay, how many other names are out there like that can also make their debuts? Do you think that those names, the CoreWeaves, the Circles, the performances that we've seen there are enough to actually propel some of the other IPOs that are on the sidelines or waiting in the wings, getting ready to make their debuts? And what's the checklist that investors should be keeping in mind there?
Well, I think it depends on how exciting the name is. CoreWeave, remember, they couldn't give it away at first, right? It came out at 40 and it was floundering a little below 40, and then, boom, it took off. Wait a minute, let's get around to this. Circle, bit sexier because of stable coins and the regulation that happened. So it depends what's coming down the pipe. If you can attach a great kind of cool story to it, forward-looking whiz-bang approach, sure, off to the races. If not, it's got to sink or swim on its own fundamentals. And the ones that are reliant on fundamentals are doing okay, whereas the stuff that's relying on a good story or positive momentum or vibes are doing much better.
Steve, stick with us. We've got a little bit more to discuss here. Coming up, what's next for small caps in the second half of the year? We'll discuss that next. Now time for some of today's trending tickers. We're watching Constellation Brands, AstraZeneca, and casino stocks. First up, Constellation Brands rising ahead of its quarterly earnings report, but one analyst says revenue may actually decline 4 to 5% due to pressure from the sale of its Svedka vodka business and tariff headwinds. Citi also calling out subdued trends among its Hispanic consumer base, which accounts for around 50% of its beer business. Taking a look at shares of Constellation Brands, they are still higher on the day by about 2.7% going into the print, set to come after the close. But the sale of the vodka business and then additionally one of your core consumer bases, any type of hit there certainly would send jitters among some of the investors out there.
Indeed. I mean, we've been talking about moving parts that are going on all the time, and certainly, they import a lot of stuff, and I've read various anecdotal evidence, because I certainly, I'm not privy to it, but about a lot of, Hispanic consumers staying at home as much as they can. They're only going out as much as, by necessity, and in many cases keeping their expenditures low because of the uncertainty surrounding what might go on with ICE.
Yeah, and that crackdown certainly has just put a lot of fear into the system. And to your point, it's meant less perhaps going out, food away from home, or purchases into some of these Constellation Brands, where we do know we're going to be watching across the beer and of course the spirits, the wine and spirits business as well here. So we're going to be keeping tabs on that one. You can actually watch later on today as well. We'll be breaking down those earnings live as they cross. Plus, the AstraZeneca CEO wants to move the stock listing to the U.S. According to a report from the Times, the CEO reportedly frustrated with restrictions in the U.K. on medicines by the National Institution for Health and Care Excellence. AstraZeneca is Britain's most valuable public company, so this would be significant. I imagine that both the NASDAQ and the New York Stock Exchange listings teams are rubbing their hands together, trying to figure out, okay, well, if you want to come to the U.S., we're all ears, and we happen to be the listing exchange and venue just for you.
Well, I believe AZN ADRs are traded on, I don't have it in front of me, I believe it's New York. Historically, the three-letter symbol was New York. So I think they've had them for a while. So they're just, but if I were to think a little more in a more crass frame of mind, I would say that if they moved to the U.S., they would probably instantly become a member of the S&P 500.
Yes.
Much more money is indexed to the S&P 500 than it is to the FTSE 100. And so you probably think there'd be a little bit of a kick up in that regard, depending on weighting and depending on how much money is weighted. I have not had a chance to really get into the math, but that would be the way I would approach this in terms of being a positive or negative. The rest of it, companies are going to do what they're going to do. But I think from a market point of view, that's the way that's the analysis I need to run, which I've not had a chance to do.
And as of right now, the NASDAQ currently holds AZN, those U.S. listed shares here. No, just to provide the context for our viewers here as well, which could get us into how both of these listing venues and exchanges are even continuing to try and figure out, all right, who can continue to kind of joust and use that in their positioning for future listings as well. Also, finally, casino stocks like Las Vegas Sands and Wynn are rising after Macau gaming revenue blew past expectations in June, rising 19% according to the Gaming Inspection and Coordination Bureau. That monthly gaming performance lifted by concerts from artists like Cantopop icon Jackie Chung. I can't say that I've been to any recent concerts that Jackie has done, but no doubt a lift here for what Macau is reporting, at least in this most recent period.
Never been to Macau. I'm certainly not familiar with Cantopop, so I'm going to have to just sort of say I'll take these numbers at face value and say if it's good for the stocks that are in Macau right now. How long of a lasting trend? I can't opine.
Which you and I have been talking music in the breaks. Our viewers are not seeing that. Steve has immense musical knowledge here, and so perhaps both of us need to add Cantopop to our summer playlists here as we're getting ready to go to the beach or just go outside for a walk.
I've experimented in J-pop and K-pop, so
Word.
I guess C-pop is probably the next way to go.
All right, invite me on your next walk. We'll get some steps in together and close our move rings. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, we're officially at the midpoint of the year, and that milestone is a great opportunity to look back at calls investors and strategists made back in January. Joining me now, we've got Jonathan Boyer, who is the Boyer Research President. You joined us back in January, and you had 3 picks from your Forgotten 40 list. All names you predicted would outperform in the year ahead, and all 3 have outperformed the S&P 500 so far this year. They are down today, but of course, it's the longer term that we're looking at here. And so, as you're thinking through and taking an assessment of those names and how they have performed here, walk us into your thinking for the second half of the year. Are you leaning further into those names or rotating?
First, thank you for having me. And yes, the Forgotten 40 is the 40 best ideas for the year ahead. Uber, Markel, and Atlanta Braves Holdings, they all had short-term and medium-term catalysts. They've all done nicely, but we still think there's more room to run in each of them. Uber is an extraordinarily interesting name. And finally, one of the things that I think is helping the stock is how muted of a response the robo-taxi event Tesla had in Austin was. Investors are finally starting to realize that autonomous vehicles is a beneficiary, not a threat, and we think they'll continue to do so, although there could be fits and starts along the way as Elon Musk makes his announcements, which generally have not come to pass.
Well, to your point, yes, and I agree on that last point. But as we think about the reaction, the stock price correlation to these events that Tesla holds, how big of either a weight or maybe just a further proving point for what Uber has talked about, even since they've gone public, in that autonomous driving will bring down their operating cost per mile, and thus that's something that they have to invest heavily in over the course of the next several years. Do you see us finally hitting an inflection point for Uber as consumers become more, more familiar with these types of services that are going to offer them driverless vehicles and driverless rides?
Well, two things that are interesting with that. One, if you look at the stock market reaction on Elon's announcements, they've gotten less dramatic over time. I remember a year or so ago, the stock was down probably 15-20% in a month over these fears. Now it's much less so. And in terms of the investing part of it, the beauty of owning Uber is it's really a capital light model. Waymo, Tesla, all the other ones are the ones investing a significant amount of capital. Uber is just going to be basically collecting a toll, which is a great business. We'd much rather own that than the capital-intensive, heavier businesses.
And then additionally here, let's walk through some of these small caps that you're identifying and really believing in for the second half of this year. Where are you seeing those opportunities?
Yeah, it's broad-based. Small caps are probably one of the cheapest areas of the market. Generally, they do extremely well after the Fed stops the rate hiking cycle. That has not come to pass yet. And they're also insulated from, or it could be a beneficiary from tariffs as people invest more in the U.S., or companies do. One of the ones that we really like, and we discussed on your show last time, is Atlanta Braves Holdings. There's 2 catalysts, one short and one medium term. The short-term catalyst is the 2-year spin-off milestone from that they have is set to expire in July, which means they can be sold without any adverse tax consequences. And it's controlled by media mogul John Malone, who is not an emotional owner, and we think he'll take advantage of these high prices in these trophy assets to sell the team. Plus, in 2027, there's a new tax law that comes out that gives publicly traded sports team, puts them at a significant competitive disadvantage to their privately held peers. And I think it'll force companies like Atlanta Braves Holdings and other publicly traded sports teams to go private.
And as we're thinking about some of the small caps play, and really as you were kind of diving in on this specific play here with the Atlanta Braves Holdings, I wonder more broadly across small caps right now, if it's wise for investors to be stock picking with small caps, or if you go towards an index or perhaps an S&P 500 or an S&P 600 rather that has a profitability filter on it?
Yeah, I mean, listen, we're biased. We're stock selectors. I think if you're able to do the research and pick the right stocks, that's where you want to go and find these kind of one-off names like Atlanta Braves Holdings or Scott's Miracle-Gro or some of these others. If not, I think investors over the long period of time probably will do fine in the S&P 600 index, but I think stock picking can do extraordinarily well over the next 3 and 5 years, especially in the small cap arena.
All right, you were talking about the Braves, and that had me looking up the freeze from Atlanta Braves games. He's got to start winning some of these races, man. Jonathan, thanks so much for taking the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Market Catalyst. Once considered a niche corner of the cryptocurrency world, stablecoins have gone mainstream following the Senate's passage of the Genius Act. We sat down with the co-CEO of Kraken to discuss what this means for the future of the cryptocurrency exchange.
So what's really important is for any of these markets to evolve is market stability worldwide. And US has now become at the forefront of promoting crypto technology, innovation. And Europe is in the same place where they actually designed and implemented what we now call, MiCA in Europe, and in Asia is sort of following suit. I think what's important is that the world has already moved forward from a regulatory perspective on what this looks like. How does it deemed safe and secure on behalf of everyday consumers, everyday traders, everyday folks that want to be able to save and get yield. And so what happens is that now institutions, traditional banks, traditional investment banks, any of the what we call TradFi individuals are now coming into the ecosystem wanting to participate or partake in what crypto means for them, not just on behalf of them to make money, but on behalf of what their clients get access to and the types of yields that they want between what I call TradFi, centralized finance / crypto, and now DeFi, what you're starting to see emerge in the market.
Recently, you've received a license in Ireland to allow from the regulator to allow you to trade across the whole of the European Union. Coinbase did the same thing in Luxembourg just before you. That doesn't really scream of a new decentralized sort of platform for cryptocurrency?
So being regulated in any market means what are you doing to protect and serve your customers? It doesn't mean that our customers cannot have decentralized wallets. It doesn't mean that they cannot transact with each other. It doesn't mean that they don't have full control over their assets and that it cannot, it may or may not be rehypothecated. So it just means that we're under compliance under European, now MiCA compliance. The same is going to happen here in the United States between what they call the Stablecoin Genius Act, and then hopefully by the end of the year, the market structure bill. It's just more about what are the rules of the road in order for you to build innovative products upon.
Now, you've launched a peer-to-peer payments app called Crack just last week. How does it actually work, and what was your motivation behind this move?
So the motivation really was that we wanted to be able to build what we've already built, which is on our exchange and for our professional traders. They use our products every single day, again, to trade, but they also use our products to save, to custody, to lend or lend against. And so what we wanted to be able to do is that because we are offering these products to a different caliber of customers, again, professional traders, that those specific services should also be available to the everyday individual, and we can make it free. So the ability to send and receive payments or send and receive money in any type of collateral that we have on our platform or listed on our platform for free, we thought was integral and one of the most meaningful things that we could do on behalf of a larger audience. In addition to that, when you send and receive, you want to be able to store. Once you store, you want to be able to think about investing, and beyond investing, you want to think about what savings and yield could look like. And so we wanted, again, to be able to offer these products to our customers at a greater distribution level across multiple jurisdictions. So today we're available in over about 180 jurisdictions and countries to be able to send, receive, store, save, and yield. Upwards of between 5% USD, 4.8% USD related yields, all the way up to like 8 to 12% in crypto related yields.
Now, we've seen reports that Kraken will soon be a publicly listed company. Are you still planning on an IPO in 6 months or so?
So we've, first and foremost, always been as transparent as possible to our customers. Again, the promise of crypto has been transparent and transparency into a transaction on the blockchain. So for Kraken, our goal has been culturally, well, let's make sure that we show our proof of reserves for our customers' assets. Let's make sure that we show our financials on a quarterly basis to our shareholders, our employees, and our customers. And what's really important is the trust that you have with your customers is your currency. So we use this term a lot, like trust is our currency. And so as we gain larger market share in some of our markets, as we launch out new products, what we want to be able to continue to show and disclose to our customers as we grow in these markets is that here's how we operate efficiently, here's how we operate in terms of stages of growth, here's how we think about building out new products, and here are the results to substantiate the way in which we're moving on behalf of you. And so if we think about going public, regardless of the timeline, it's going to be, in essence, to be able to show continued transparency, and that is in the best interest of our clients and our customers, not in the best interest just for us.
So were the recent job cuts around, I think, 30% of your total workforce related to being IPO ready?
No. So the way we think about building Kraken, and at one point we were almost double the size of where we are today, was that, look, during 2022, and when you had this spike in growth for not just Kraken, but a multitude of companies in the startup ecosystem, as well as in the public markets, people tended to overhire, overallocate, and overspend in areas that were just inefficient. Similar to how you think about the government being inefficient, right? We're in times of what I'd call gluttony. And so a lot of what we've been doing is just making sure we're back to being fit to the standards of what we consider performance-driven culture.
Now, we talked about you getting a license in the EU, and we know that Coinbase have got one as well. So who's going to win between Kraken and Coinbase in the EU then?
Look, we don't consider ourselves as competitors to a lot of the ecosystem, and here's why. There's a certain set of folks that traditionally focused on consumer. There's a certain set of folks that traditionally focused on institutional. And as I mentioned before, we focus on professional traders. The professional traders that trade with us every single day, day in and day out, allow us to innovate new products, case in point, Crack, to be able to deliver that for free. And so when I think about what we're trying to build, we're building a family of brands and products that are powered by our exchange. And when I think about the competitive landscape, they might be building a very specific set of products for a very specific set of customers. I'm thinking about what we can do in a broad way, but also making sure that we can stay focused on the core and making sure we can grow in both directions. And I think the duty of any company is that the profits that we drive are driven back into building out more and more innovative products so that we can continue to grow on behalf of the customers that we want to be able to continue to attain and attract longer term.
The Senate's marathon session could be coming to a close as a final vote on the GOP tax bill is expected soon here. Senate Majority Leader John Thune telling reporters he believes there should be enough votes to pass the legislation. It comes as President Trump and former ally Tesla CEO Elon Musk, they continue to trade barbs on the cost of the bill, with Trump this morning threatening Musk's government contracts here, as Musk took to Twitter to argue against raising the debt ceiling and government spending. Yahoo Finance columnist Rick Newman argues Musk may have some salient points about the tax bill. We were just taking a live look at some of the voting in progress on that tax bill here. What are the points here that are salient and do hold some weight?
Well, just so people understand, once the Senate passes this, it's not over. That's a different version than the House passed, so the Senate version would have to go back to the House, so it's still going to be a while before we get a final bill. But Musk has pointed to the overall cost of the bill, $4 trillion added to the national debt. But he also is into the details of some of the things that are in the bill, and he has specifically looked at the energy provisions. So what this bill would do is it would repeal some of the green energy tax subsidies or tax breaks that Congress passed in 2022 when Democrats controlled Congress and Joe Biden was president. And it would give some aid and smaller subsidies to fossil fuels, oil, natural gas, and coal. And Elon Musk says that basically amounts to
subsidizing the industries of the past, that's his phrase for fossil fuel basically, while giving up strategic advantages on the industries of the future, which is green energy. And he's right about that. You can have arguments about what's the right level of subsidy for a new technology such as green energy. But green energy is a super important industry of the future, and here's one way you can tell. China has said that green energy, including electric vehicles and batteries, photovoltaics for solar, wind power equipment, they have declared this as a strategic industry where they want global dominance, and they're on their way to global dominance. So the Biden era subsidies were supposed to help the United States catch up. I mean, you want to be in this industry. This is a massively growing industry. You want to be there. There are a lot of jobs there. And I think Musk is right when he says they're going the wrong direction on this.
I mean, as we're thinking through the passage of this bill, what are the biggest points of contention that you think could still hold this bill up, if any, at this juncture?
Well, there's this. So in the Senate, there's some opposition to cuts in Medicaid, which is basically what this bill does is it takes away some health and food aid benefits for poor people, in order to subsidize the tax cuts.
SNAP benefits.
That's right. And when you look at what they call the distributional analysis, like how is this going to affect people in 5 different income quintiles, people in the bottom 20% and perhaps even the bottom 40% are actually going to end up a little bit worse off, according to the Senate version of this bill, while the upper 20 and the upper 10% get the biggest tax break. So, I mean, the way this is structured in the Senate, it will literally take from the poor to give to the rich. That's just bad politics.
Rick, thanks so much for breaking this down, tracking all the developments. We were just taking a look at some of the live shots coming out of Washington, D.C. We'll continue to track that as well. Steve Sosnick has been joining me for the hour here, and I just want to get some of your final thoughts here. And it seems like, based on the conversations that we've had, there is a great intersection of major events that is happening, as we well know, but on this tax bill front, and then additionally on the tariff policy front, where we're waiting for several deals that need to get done. What is the timing of all this and the significance around that timing and how this intersection is happening, impacting or at least influencing the market psyche right now?
I kind of say it's almost not. It's basically the market is looking through it. As I have here, just give me a second to stare at my screen. We're below 17 in VIX right now. Remember what VIX is. We always talk about it as being a fear gauge. I've often said VIX is not a fear gauge, though it plays one on TV. But what it is it's the market's best guess as to what volatility will be in the S&P 500 over the coming 30 days. A 16 VIX translates to about 1% intraday moves, not close to close, just high-low. So we're basically saying that despite all the things that are coming down the pipe in the next 30 days, we're at a relatively sanguine level right now. We're not too concerned, but people are not looking for hedging protection against any of this stuff. Therefore, one has to think, all right, they're kind of not particularly concerned about all this stuff. And so that to me is when you get more surprises. More complacent markets tend to be a little more easier to shock than nervous markets. If you're already nervous, at some point you can't get any more nervous. If you're pretty complacent, you can upend things. And so that to me is really going to be the question: is how does the market react to the politics of taxes, tariffs, and incoming earnings?
Does complacency lead to risk on, or does it say, okay, I'm comfortable in positioning that I have now, or just comfortable getting into the already overcrowded areas of the market?
I think in general, it's not bad if you just sort of see a broad market that's participating everywhere and it sort of gently moves around. Right now, what we're seeing is this rush into, and in some days, some rushes out of very, very popular investments. That's where the complacency starts to come into play. I'm not too concerned about, let's say, these high dividend, low beta value stocks that really haven't done all that much in the last 3 months anyway. I'm much more concerned about the high beta, big cap stocks that have been leading the rally, because bear this in mind, in April,